Recently, equities and bonds have drifted lower from their May highs, mainly due to the US Fed indicating the level of asset purchases under QE3 will be reduced later this year if the US economy improves in line with its forecasts. Given that monetary stimulus has been supportive of equities and bonds, both fell on indications of its withdrawal. This chart highlights the sensitivity of global equity markets to levels of central bank asset purchases, with equities weakening in May when the Fed chairman suggested QE3 tapering could begin over the next few Fed meetings, while in June they fell further as more definitive guidance was given in relation to the timing of the beginning of reductions in asset purchases. They have, however, rebounded from their lows, as it has been speculated that tapering might not necessarily begin in September as originally expected. Similarly, global bond prices have fallen with yields moving higher, given the possibility of lower levels of central bank buying of government bonds. Yields had been edging higher from May on improving economic data, but spiked even higher in June on the Fed announcement. As with equities, more recently bond prices have rallied and yields fallen from their highs, given the possibility of a later reduction in QE3. The Fed's forecast for growth in the US economy this year is between 2.3 and 2.6%. With growth of only 1.8% in the first quarter and 1.5% forecast for the second quarter, growth would have to pick up to over 3% in the second half of the year to meet this forecast. While the economy is improving, it is unlikely to reach this level of growth by September, which is the month in which tapering of QE3 is currently expected to begin. Since the Fed meeting in June, some members have been downplaying the timing and extent of any easing of QE3, although messages remain mixed. As a result, it is possible that tapering could be delayed until December. The Fed has emphasised any decision on reducing QE3 will be dependent on economic news flow, is just a reduction in the level of stimulus, not a withdrawal of stimulus, and will be reversed if conditions deteriorate. If tapering is delayed until December, markets should rebound from recent losses, but even if tapering does begin in September, the level of asset purchases between then and the middle of 2014 will likely exceed $600 billion, more than QE2 in total, and therefore support for equity markets should remain significant. The Fed have said that economic growth will have to be sustainable before they exit QE3, and if this improved economic outlook proves to be correct, it should also be supportive of equity markets and offset lower monetary support. More recently, the ECB and Bank of England have also indicated that rates will remain lower for longer than previously expected, also being supportive of equity markets and bonds. Not having experienced an exit from such extensive QE programs previously, the best guide to look at what might happen in markets is to look at previous interest rate tightening cycles in the US. This table shows US equity markets in the year prior to the beginning of rate rising cycles since 1954, and performance 1, 3, 6 and 12 months after the first rate hike. On average, equity markets are flattish in the months immediately after the first rate hike, sometimes showing losses in response to rising rates. Typically, however, 6 and 12 months afterwards, equities are higher as the benefits of improving growth, which drove rates higher in the first place, offset the impact of rising interest rates. If the same circumstances unfold on this occasion, while the next few months might remain volatile depending on news flow, equities should continue to move higher over the medium to long term. Figures for 2013 relate to May the 21st, the date on which markets reacted to Bernanke's suggestion that QE3 tapering might begin this year. In relation to bonds, in the short term, yields could fall further if tapering of QE3 is delayed, although by year end they could move back to recent highs on better growth and the actual beginning of reductions of asset purchases. Thereafter, low global inflation could leave bond yields stable.